At the start of every year, I like to review the biggest winners and the averages. And while the top 10 players in the Dow are pretty straightforward, the top 10 in the S&P 500, they're a lot harder to fathom about what happened. First, there's AMD, the chip maker that folded 148% last year. There are a lot of reasons for this run, but they all start with Lisa Su, the visionary CEO who saw exactly what the PC, server, and gaming markets needed. Can you believe that? She executed a tour de force turnaround in 2019. The question is, can AMD repeat that performance? Listen, when the company reported last, we heard endlessly that it had a weaker than expected quarter, but you didn't hear that from me. And after dallying in the low 30s for a bit, it erupted to the high 40s. I think this negative assessment was crazy. When you consider all of the issues that are plaguing Intel, its main competitor, I think this company's got a bright future. Second best performer, Lam Research, up close to 115%. This semiconductor capital equipment maker is benefiting from its terrific new CEO, that's Tim Archer, who bought back a massive amount of stock when Lam Research was a lot lower. Even better, the semiconductor cycle is bottoming, which is when Lam's stock comes roaring back. We own this one for the Charitable Trust. But you know what? Candidly, we've been ringing the register here, at least on some. Why? Because the stock simply isn't as cheap as when we first started buying it, which, by the way, was along with Tim Archer. Still, I wouldn't sell everything here. When the semiconductor cycle turns like it did in the fourth quarter, you can throw money at this group and make a fortune. That's why KLA Corporation, the company formerly known as KLA Tencor, was the third best performing at 99%. However, the trick with these stocks is to buy them before everyone realizes that the turn is at hand. That's why we're ringing the register. The easy money has clearly been made in both stocks. The fourth biggest winner is nothing short of incredible. I'm talking about Target, with its 94% gain. There's been a dramatic schism in retail between the haves and the have-nots. The haves are embodied by Watch, my acronym for Walmart, Amazon, Target, Costco, and Home Depot. In this environment, you either need to be a dominant player online or you got to offer customers incredible prices. Target does both. Now, all five of Watch are remarkable in their own way. But Target stands out as the best performer thanks in part to the remarkable leadership of CEO Brian Cornell. As I look back on the biggest winners of 2019, I am astounded how many of these companies were thought to be second-rate operators. Same thing with AMD and Lisa Su. At least coming into the year, with Target, lots of analysts saw them as a roadkill for Walmart and Amazon, thanks in part to their lack of a serious omni-channel strategy. But Cornell laid out big bucks to buy Shipt, SHIPT, beefing up his same-day delivery capabilities, and he doubled down on high-quality private label brands where the money is. He defied all conventional retail wisdom and developed a multiple form factor strategy, small urban, large urban, and hitherto underserved neighborhoods that other companies had given up on, college campuses. Like Lisa Su, I think Cornell is one of the greatest turnaround artists in the history of American business. Hey, speaking of turnarounds, the S&P's fifth best performer was Chipotle, CMG. Everyone who gave up on this thing after its streak of health scares has now watched this train leave the station. It is never coming back, people.
All aboard!
Historically, we know it usually takes the American people roughly 18 months to forget about these food scares. And that's exactly what happened here. But Chipotle also got a major boost after it brought in Brian Niccol as the new CEO in 2018. Oh, the skepticism was thick. Niccol used to run Taco Bell, which seemed like the polar opposite of the natural and organic Chipotle. Well, in the end, Niccol preserved everything that was good about the company while getting up to speed on throughput, technology. When the customers started coming back, they found the place as scrumptious as ever, but also far more convenient. Hey, sometimes they didn't even come. They used the Chipotle through lane, the Chipotle, or even better, they had it delivered. Throughout the downturn, Jack Hartung, the amazing CFO, never strayed from coming on this show, no matter how weak the numbers were. Hey, that's another sign of a tremendous company. The fact that Chipotle's just going back into the double-digit same-store sales tell me there is more good ahead here. The sixth best performer is a play on 5G wireless called Corvo, and though the stock was up 91% last year, I think you ain't seen nothing yet. 5G-oriented chip makers like Corvo have been on fire, lots of profit-taking today, and though I like Skyworks Solutions better, profit-taking there, Corvo has more room to run because its stock was so hated coming into the year. It's not as hated now. Number 7 is one that you may never heard of, even though it was up 90%. It's called Copart, C-O-P-A-R-T. We often hear about the digitization of entire industries. But did vehicle salvage business, well, was that digitized nationwide? Yes, by Copart. When you have a natural disaster like Hurricane Harvey in Houston a few years ago, Copart comes in. Now it takes care of the car and truck detritus. Just wanted to say that word. The company also is taking car auctions, which used to be quaint local affairs, made them national via the web. Even though Copart is an incredible, powerful story, the stock is ridiculously underfollowed by Wall Street. It sells for 32 times earnings. I think you can keep going higher until we start hearing from analysts recommending it. And then maybe I say its time has come to sell. Copart's a lot like Cintas. That's the uniform rental service. It's its own special category of its without much competition. I'm betting that makes the stock even more likely to rally in 2020. And if this turns out to be a bad year for hurricanes, holy cow, the sky's the limit. Eighth best performer, Quandary, Xerox. This is a restructuring play that made a fortune selling its part of a joint venture with Fujifilm. Now Xerox is trying to sell itself to HP, even as management's presenting itself, frankly, as the buyer, not the seller. Quizzical. It was only 2 years ago that HP tried to buy Xerox, so I don't get the aversion now, except, of course, that Xerox stock is up 86.6% last year. I think that may be running out of gas. I recommend selling some Xerox if you own it. Number 9, Applied Materials, another semiconductor capital equipment company that's been roaring the same reasons as KLA and Lam. Finally, number 10, Apple. The only Dow stock to make it in the top 10 of the S&P. I know I covered it well. I remain a champion, like I told you earlier. Own it, don't trade it. Still working! Bottom line, when you look at last year's best performers, the S&P 500, you see a lot of companies with phenomenal management that were unfairly written off as losers and then came roaring back thanks in part to improving fundamentals driven by the CEOs. I think the ones that are riding powerful secular trends have a lot more room to run. I need to speak to Buddy in Connecticut. Buddy!
Hello, Jim. First off, Happy New Year. And, Jim, I want to wish you many more.
Oh, same to you and your family. Thank you so much.
Jim, currently I have a large holding of MasterCard, and seeing it has had such a long-term run-up and hitting all-time highs, I want to ask you, your opinion. Should I hold, reduce, or purchase more shares?
Okay, so you may know we've got this club, ActionAlertsPlus.com club, where we talk about stocks all the time. And I discussed this back and forth email yesterday with the group, with Jeff Marks and Zev Fema. And what we decided was, no, MasterCard's going to have terrific double-digit growth. No, it's not time to sell. If anything, on a dip, buy. Marcia in Kentucky. Marcia.
Yes. Hi, Jim.
Marcia, how are you?
Good. I'm calling from Bourbon Country now in Louisville, Kentucky.
All right.
And my question's concerning Twitter. I purchased it right after the IPO in 2014 for $30 a share. So should I hold it or sell it? And what stock would be a better investment for this sector if I sold it?
Okay. On Mad Money, we believe it doesn't matter where you bought. It matters where it's going, and I think that stock can go higher. I believe I was talking to my writing partner, Matt Horween. It looks like it's finally basing. That's the stock. The business is okay, not as great as I'd like it, but I think it can be owned, not sold. New year, same mission. Last year's best performers are riding powerful trends or have unbelievable CEOs, or both. What's more, Mad Money had tensions with Iran or escalate. But what does it mean on the cyber front? Boy, those stocks were hot today. Well, what a lucky break. We got the CEO of CrowdStrike. Let's see what he's thinking. Then worried about the geopolitical tensions with Iran and how it'll affect the market. I'll tell you why that may not be the real issue in this tape. And all your calls rapid fire in tonight's edition, the first one of 2020, the Lightning Round. So, Ski Daddy, stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.